While everyone's holding their breath for tomorrow's meeting in Europe, investors have high hopes, leaders have major decisions. I want to welcome Mark Blyth. Mark is a professor of international political economy at Brown University. Good morning, Mark. Whenever I talk to you on the radio, the emails flood in. You're pessimistic and you're pretty colorful on Europe. So tomorrow is the breakthrough that we're all waiting for.
Well, breakthrough or breakdown, we're going to find out one way or the other. We've had, I think, 7 of these summits so far, and it's a question of what's this one going to deliver that the others haven't done so far. The problems that we're facing are not necessarily the problems that are being addressed, which are the size of the European banking system and its fragility, and the exposure to the sovereign bond crisis. And it's not clear that simply leveraging up the Financial Stability Fund, as I like to call it, the big bag of magic leveraged euros, is really going to be the answer that everyone's looking for.
All right, so what's the best case scenario?
The best case scenario is somehow they manage to do an awful lot all at once, which with 27 people at the table is never a good idea. You remember trying to pay for pizza when you were in college with too many people at the table? You got the same coordination problem. What they're going to try and do is deal with the following facts. You've got 55,000 billion euros in assets in the European banking system. It's 4 times the size of its American counterpart by share of GDP. A lot of that's impaired. So if you get a bank run running through the bond market, beginning in Greece, running to Ireland, going to Portugal, going to Spain, ending up in Italy, you're going to need between $2 and $3 trillion in the bank in order to do this. You can stick $500 billion in the ESFF and then hope that the leverage tricks of building it into a CDO convinces everyone that you've got an insurance policy and no one needs to worry. I'm not convinced the markets are going to buy that. But at the same time, is it really credible to say that in the midst of a big recession, with austerity politics compounding the problems of the periphery, we're going to raise a couple of $1 trillion and not crowd out the rest of the market? They've got a really, really tricky thing they're going to try and pull off, and I hope they do it because no one benefits by this not working.
All right, $2 to $3 trillion. Where is that bazooka going to come from?
That's a really good question. It could come from the taxpayer because guess what? That's really the problem. At the end of the day, this whole system was set up because the European Central Bank is a fake central bank. It's really a currency board with an inflation target that's constitutionally and intellectually ill-equipped for fighting the fire it's been asked to fight. So they don't want to become the lender of last resort. They're constitutionally limited from doing so. The lender of last resort is ultimately the German taxpayer, and they don't want to pay.
Well, don't say that about the European Central Bank to Robert Mundell, the father of the euro. I went to his 80th birthday party last night. He said, no doubt about it, they're going to get through this. They're going to get through this even stronger. And the European Central Bank will have to play a major role.
I think that he's correct in the sense that that's what will have to happen. However, history is replete with things that should have happened and didn't. So as I like to put it, things continue till they don't. The euro crisis is continuing. At some point, it's not going to. That doesn't necessarily augur for a good resolution.
All right. He's pessimistic, but at least he is good at explaining the issues. Mark Blyth, professor of international and political economy at Brown University.